Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Dave Wolcott. He started his career by serving the country as a captain in the Marine Corps. Thank you so much, Dave, for your service.
You bet.
And in 2000, him and his wife brought triplets into the world, which inspired him to challenge traditional financial planning advice. I'm sure that probably does challenge that. And then today, Dave is the author, podcast host, and founder and CEO of Pantheon Investments, and is more passionate than ever about helping entrepreneurs build wealth and passively invest in superior real estate and alternative assets through predictable cash flow, tax efficiency, and upside potential as a reliable alternative asset to volatility of the stock market. Dave, welcome to The Wealth Flow. Looking forward to our conversation.
Yeah, really grateful to be here to connect with you and your audience, Keith.
Yeah, and I love to really kind of kick this off with really your background. Obviously, we talked a little bit about some of it, but I love to find out where you grew up and what eventually led you to decide to go to the Marine Corps and then to get into real estate and have those triplets along the way. So.
Yeah, for sure. I was raised in a middle-class family in Connecticut, probably like a lot of other people out there, and was taught that the recipe for success was go to school, get good grades, you're going to get a job, and life would just kind of work out, right? We also never really talked about money in our household. Dad was always working hard. There was definitely a scarcity mindset, coming from my parents' generation and the generation before them. So I followed down that path, did the ROTC program in college, and then had the opportunity to go into the Marine Corps and serve my country, and really, just learned a lot about myself, Keith, really about, just basically traveling the world, working with some amazing high caliber people, also getting shot at in a combat environment, and learning things like leadership, integrity, and teamwork that they don't really teach anywhere else in the world. After that, I transitioned into the corporate industry, got into the tech industry and corporate, and I quickly just really lost that sense of purpose, right, and mission that so drove me in the Marines, that I just felt this higher calling to. Now I realized I was starting to trade my time for money. I was working in someone else's machine, in that time and effort economy. And it was really frustrating. And then at the same time, my wife and I, we started raising a family. We had an 18-month-old toddler running around just trying to figure that out, right, as new parents. And on October 24th, 2000, as you said, we literally had triplets and quadrupled the size of our family overnight. And I could tell you, Keith, like I was literally sitting there, right, holding 3 babies in my arms at the same time, and just looking at them going like, this is just surreal. I mean, this is what you hear about on the news. You look at it on the newspaper, but it literally happened to me. And my paternal instinct just really took over. And the first thing I could think of was, how am I going to provide for financial security for my family? Right. And so the first thing I did was went to see my, my wealth advisor, and all he could tell me was, max out your 401k. And they have these great, tax deferred programs called, college 529 plans. And it was right then that I just knew that being a retail investor in the stock market was not how to build true legacy wealth. So this launched me on this obsessive journey to figure out how the top 1%, 0.01% were really building wealth. I started investing in single family, multifamily, raw land, retail, office buildings, oil and gas. And then remember, this is like back in 2000, right? There weren't great podcasts and YouTube and all these resources available. So a lot of that was actually creating relationships, trying to understand the private markets, back then. And then, fast forward 25 years later, I built a phenomenal portfolio that's cash flowing, just amazing growth. I have more control over my own portfolio. I have pay nominal amount in taxes. And then I wrote my book, The Holistic Wealth Strategy, to really help other people, figure out, what is the blueprint for actually building legacy wealth, right? Outside of Wall Street. What does that really look like so that we can create that freedom and that true life that we're trying to go after?
Yeah. Well, there's a lot there to unpack, and what I'd like to maybe hear about is, so once you kind of realize, well, first, let me just acknowledge how amazing it must be to have triplets, and to also have, that moment where you're staring at 3 babies and thinking, oh my God, I got to do something different here. This is just, it's got to be somewhat overwhelming, but you were able to, it sounds like it was the catalyst to really kind of have you think a little bit differently. Which is great.
that definitely helped. And, 2 other things I think that were key in terms of a catalyst is, the tech bubble was also just happening right around 2000. So I took a massive bath in the stock market at the time. And then I read, I took the purple pill and read, Cash Flow Quadrant, which was such an amazing insight for me to just figure out that, hey, this is the way the game is played, and I need to become a business owner and an investor and move to the right-hand side of the quadrant.
Yeah. No, fantastic book for sure. And so when you were buying the single family, you mentioned single family first and then multifamily and several other asset classes after that. Were those individual investments that you were buying and managing them yourself, or was that as part of a syndication, or how did you initially start that real estate investment journey?
That's really a good question. And I think this is a super important distinction for people out there, right? Because a lot of people think that, okay, I want to create passive income. I want to generate wealth. I want to diversify from the stock market. They're there. But one of the most important things to factor in is your time. And being an active investor versus a passive investor is very different. Being an active investor, so if you're owning whatever it is, short-term rentals, single family, it's a business. And you need to think about it as a business, and it's going to take up a lot of your time. And I also am a big proponent of spending your time on your strengths, where you have the best skill set that you can apply to create the greatest amount of value. So I quickly learned that managing, tenants, termites, and toilets was not the best use of my time, right? Even my day job at the time, I was a W-2, but I could still create more commissions and more value doing that, and then having a property manager do the other thing. So I quickly got into passive back then, Keith, because I just, I really made that distinction that, my time is my greatest asset. And also, I realized, I can tell you, I was driving around. We lived in just outside of Denver, Colorado at the time. And we were like driving around looking at properties with 4 kids in the back of the car, like at night at 6 p.m. We're like, okay, we're going to go look at this one. And then we would go, look, spend 45 minutes like checking out a property. And then at nighttime, once the kids went to bed, I'm like running numbers, doing analysis on this. But you have to remember, there's people that have been doing this for like their entire career. Right. And they have analytics and tools and resources like way beyond you. Right. There's people that are doing it completely full time. So there's actually a lot of competition, and there was then and there is now. So it's one more reason that I like to invest passively and work with mature teams, because you actually get more leverage. You work with an acquisitions guy that's been in a particular market for 30 years. And it's not about when that property came on the market. It's the fact that he got he got some inside information to find out, hey, this property's coming available. I want to give you first shot at it, and that's how you create really good opportunities.
Yeah, I think it's an amazing point. I took the other approach, and I was hands-on with everything. And I look back, and as I have these conversations on the podcast with people that have done it differently, while I learned a lot, like, man, some of those lessons were tough, and some of them I lost a lot of money. And part of it was, a big piece of it was just not having the experience and shifting from, a certain asset class from one to another. Just there's a learning curve, and you're learning a lot of times with your time and with your money. And so to be able to trust somebody who's been doing it, and has, like you said, a seasoned team, it makes a world of difference. They know what they're doing. They oftentimes have seen this building before. I've got a property right now under contract. My broker out there, he's like, yeah, we used to have this under contract on a totally different thing. I mean, point being, he's in that market. He knows it intimately, and he even had the same darn piece of property under contract, years ago. So that's a good operator as well. They'll know all the buildings that are in that asset class, and it's just a matter of where they are with it, and hopefully they get that insight, which is important.
Yeah, the other point I'd like to make here that's really interesting is you've never actually heard of people going from passively investing in syndications and kind of spread out that way with their portfolio, and then starting to go into, active management and single family rentals or things like that, right? It always goes the other way, is you start doing active management and then you move up. And there's 2 reasons for that. Is number one, you need to be accredited, in the first place, right? To be able to access some of the great opportunities. But more importantly, it's all about scale, Keith, right? Like, when you're just managing individual properties, right? I mean, you can only scale so fast. And with syndication, you can create such a much larger portfolio. And then part of our thesis is actually investing in 1 to 3 asset classes that you then start to go deep on. So we actually, not only do we like real estate, but we like energy, and we also like private credit, because there's other, tax benefits, cash flow benefits, and really strong upside potential. So that way, as you need to think of as an investor first, right? And to think about how you can diversify your portfolio across multiple asset classes, not just real estate.
Yeah, no, that's a great point. Well, maybe we can take that time to dive into that and kind of how you came to that realization. So what type of, when you look at the real estate itself, what type of asset class are you focused on right now?
So we like to look for operators that have really strong competitive niches in particular markets. So I'll give you an example, right? We partnered with a private equity firm just last year, and with the sponsor that did medical office buildings in the North Carolina markets. Now, they started, the founder who started that is a dentist, and he built over 20 different dental practices. And really, as part of that, they figured out all of the real estate for each one and how it operated, which markets, were growing and everything, and how to support that. And so now they're looking to basically scale that. So they take over 60% of the occupancy in any given building. They sign a 10-year lease. You have a fantastic tenant, which is, a dentist, and then they just fill the adjacent offices with, corresponding services like an orthodontist, right? That goes into there. And again, doctors, 10-year leases, right? In high growth markets. This is a home run. And these guys have been just executing for the past 10 years so well. So that's such a great example of just such a great niche and a great market that we can invest in, right? In terms of real estate. And then again, now as, smarter investors, right, looking at things like the pandemic no one ever thought of, 10 years ago, people still need their teeth cleaned. Right? That's still going to happen, right? And medical services are still going to happen. So in terms of, trying to insulate and trying to look at, true fundamentals of an investment and risk mitigation, right? We're always looking at all different angles, but this was a, great opportunity, to give you an example.
Yeah, no, that's a great example, and I like that asset class for sure. What are some other ones that you guys are invested in besides that one? Just to give kind of the audience.
There's
flavor.
Another asset class that billionaires have been really favoring for the past decade or so that we really started to get in on probably about 4 or 5 years ago, and that's private credit. And it's really, really interesting. It's literally an area that's been growing with a 15% CAGR over the past, 15, 20 years, and just continues to go up into the right. And the reason is that, we saw 185 banks go under about 18 months ago now. And so banks are continuing to tighten lending standards for small businesses, people that need capital, right? And in our credit-based economy, people need capital to grow. It's just that simple. But a great example of this is I live in Florida, and, last year we had 2 hurricanes that come in. So you have let's say a roofing company, right, that all of a sudden has 2 years backlog of work that he literally just cannot fulfill. So he's got so much business and so much demand coming in, but he doesn't have enough capital to go buy the equipment. He can't get the crews going and everything. Well, with private credit, he can actually be underwritten inside of a week. And now he's got his capital to capture that revenue. He's going to pay a premium for that capital, right?
Yeah.
But he's still going to work out a lot better, right? Because now he's able to capture that, and still, once that's paid off, his margins are going. So we basically invest in private credit for small businesses across 15 different sectors where you can cash flow. I mean, we've been cash flowing this thing well over 20%, for 3 years. And also the cycle on these things is an average of 7 months. So when that borrower takes the capital out, he's paying back principal literally on a daily and weekly basis that we actually reinvest into other deals. So it further diversifies the deal and creates so much velocity of capital in that it's really strong. And then you can also invest. Obviously, there's different ways to invest in private credit. It's now becoming a little bit more popular on the real estate side, but you can do it on the business side. You can do it in defense contractors, all kinds of areas. But anywhere where you can be on the right side of the equation, right, which is you get to be the bank, that's a great place to be for an investor.
Yeah, and a lot of times from a lending standpoint, you're in a good position as well because you're looking at these people. You're going to get good returns. You're going to put some kind of a lien on either their existing stuff. I mean, there's going to be some way that you're going to protect that capital that's being invested, and they're open to do that because they need the tool of that capital. But you have the ability to position it that, if something goes bad, you'll be able to get your money back, type of thing. So
yeah. And then the other asset class that's really interesting, Keith, again, looking at, macroeconomic fundamentals first, is energy, right?
Mhm.
And it doesn't matter where you live in the world or what industry you're in, but the demand for energy is completely outpacing supply, right? And especially with the AI boom that we have. And a lot of people don't realize, especially real estate investors, yes, there's great advantages to real estate investing on the passive side, but if you're an active income professional or you have a business that's generating active income, a lot of people don't realize that, up to 100% of your investment can actually be offset when you invest in oil and gas. And not to mention, you're really diversifying into a commodity, right, that everyone needs and is growing. It creates cash flow. There's also upside potential. And it's a great thing to really be adding to your, portfolio stack.
Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. And so where are you investing in that? Pretty much everywhere, or what? Tell me a little bit about, all oil and gas kind of varies, right? So we've had quite a few folks on the show that, do anything from investing in the infrastructure, taking existing wells. What angle are you guys kind of looking at? Let's unpack that maybe a little bit.
Yeah, for sure. We typically like, working interests in upstream production, and we're only focusing on really institutional quality operators, right, that are much more proven, very safe in terms of capital. Because just like on the real estate side, you can have operators that are just, let's say, they don't have as strong of a track record, or there's more risk, or they don't really have the resources to be able to execute the business plan. So we continually are revising our due diligence, but really trying to identify the same thing, right? Operators that have a really unique niche. They've got a fantastic track record. So in that case, we're mostly looking at, working interest, and that's in both oil and gas. And we also have found a strategy where there's actually some hedging that can go on. So even the biggest risk in oil and gas, besides the operator, is price sensitivity. But if you wrap in a hedge play into that, you can be really mitigating that all along, right, as kind of price volatility goes. But this is where I think for the most part you can get the majority of the tax benefits and structure it in a way that's really impactful for that year. Like we just closed out one for the end of the year. A lot of people don't know what their tax situation is till November, and they've got limited time to actually do something. So that's why we typically like that as an option for some of our investors.
Yeah, exactly. And with oil and gas, and correct me if I'm wrong, but there are some benefits that are a little bit different when it comes to the depreciation that you can get from that than, say, from a real estate transaction. Real estate, if say you're exiting one deal, you're going into it, you're going to redeploy that capital into another. You have a great opportunity to take away those capital gains by doing that. But with a lot of folks, if they're not a real estate professional, their income isn't necessarily going to be able to, from their W-2 isn't necessarily going to be able to go away from or cancel out some of it. But with oil and gas, there's a little bit of a difference or a nuance with that. Do you want to speak to that maybe a little bit?
Yeah, 100%. It's basically active income. And so the way that works, right, is when you get your K1 statement as a real estate investor in an investment, you'll see there's a box for passive income and then there's a box for passive losses, right? And those passive losses are, created because you've done a cost segregation study and tried to pull those losses forward to create that. But you can only take those losses against the passive income. So what's great on the energy side with oil and gas is you actually will sign, this is a distinct difference some people don't understand, but you'll actually be a GP instead of an LP in the oil and gas opportunity. So therefore, you create that active status as a GP, and then you'll get that active loss. We were just about 89% on last year's. So you get a loss of up to 89% in that first year that you do the investment. And then again, it's offsets any type of active income. So if that's W-2 income, this can be capital gains. This can be, you could have exited your 401k and you're trying to offset, gains there. Basically anything that's going against your AGI, it can reduce that total amount down. So that's pretty significant. And especially when you look at like from an IRR basis, if you include, taxes, we had an IRR like over 60%, right, on that opportunity last year. So we're always looking at time value money and how can I accelerate that as fast as possible in different deals, in different structures, right, to get to what most people are looking for, which is really financial freedom, right, in this whole game.
For sure. Yeah. And you mentioned also with the oil and gas, and obviously right now, with the price of oil being down more than, it had been, people are wondering about it. Like you said, there is a way to hedge that. Can you explain that a little bit more, just for the audience sake, so you can get commitments, right, on, the production that's going to come out of that in advance at a set price for a certain amount of time, and whether that be the gas, whether that be the oil that's coming out. I mean, there's ways to go ahead and negotiate a set term or a strike price that you're going to be able to get, so that you can kind of take away that volatility on the investment side.
Yeah, exactly. So we're basically, buying, right? Buying all the time, and we'll have that strike price, right, at a lower amount. And typically, I mean, over the past, if you look at any given, 10, 20-year period, right, it's somewhere around like, $72, something like that, a barrel on the oil side, right? So as long as, we can maintain, I think in this fund, it's something like 40% of it has this collar strategy where we can actually buy at the lower price, so that now, as there's a little bit lower prices in energy, we've got much less exposure to that, and it's continuing to grow. Gas, on the other hand, is running very strong, and this is another way to look at opportunities if you have some kind of diversification a little bit in between gas and energy. And then the other thing I would add, Keith, is back to the tax side, which is interesting. Unlike real estate, is people often forget about the recapture. When you get those passive losses, is there is going to be some recapture in future years, right? That sometimes people are a little bit surprised by. But what happens in oil and gas is your basis, because of the offset up front, and your basis gets knocked down so much, there's very little recapture. It's almost basically negligible or completely offset.
Yeah, no, that's a great point. That is a great point, because it does happen. We have our first cost seg that we did was on a vacation rental, and the vacation rental was like, during COVID and all that stuff, that we were like, all right, we better get in on this. And then, a year or so after coming out of that, the market for the vacation rentals wasn't quite as strong. So we're like, man, I have some money wrapped up in this. Should we sell it? But there's a recapture that we would have gotten. It was very handy at the time. I was exiting another property, but we would have had to, kind of recapture when we sold that. So it kind of we would, even although we've been getting equity out, we would have had to pay basically a lot of what we were, had saved initially back to the IRS. So.
Yeah.
But well, no, this is great. So you guys kind of have a variety of different options for different investors. You want to maybe talk a little bit about, from an investment standpoint, how long some of these different opportunities typically go for, what the ideal investment timeline or horizon is, and just kind of the specifics as to why one investor might want to go in this versus this. When it comes to some of your offerings.
Yeah, for sure. I mean, I think most people should be aware that if you're investing in the private markets, there's typically a lockup period, I would say, of around 5 years. And whether that's real estate or any energy or some of these other things, the reason is because, we want to be able to move through cycles. Most cycles average about 3 years. So you don't want to be selling, right, in a down market. You want to have some flexibility to kind of manage that. And it's probably, one downside that, Wall Street might talk about in terms of, private equity. It's like, well, you need to be more liquid, right? But our recommendation, we are a family office. We run a multifamily office, and we basically are co-investing in different opportunities with investors. And so the way we kind of look at it is really setting up what we like to call this basically a pyramid for your portfolio, and looking at it that way versus a pie chart, right? So we follow like the Yale endowment model or Tiger 21. Like I've had Michael Sonnenfeld on our show with Tiger 21. I mean, they literally only have about 22% exposure to public equities. Right. Yeah. So we see public equities really on the top of the stack because you have liquidity, but you have no control. Right. You're just kind of on this seesaw of volatility. You're also paying the most in taxes. Right. And, you're just completely correlated to the market there. Now, at the bottom of the pyramid, one of the tools that we like to use is actually infinite banking or cash value whole life insurance policy, which works great. Yeah. You've probably had some guests on the show really talk about that. But one of the things we've learned, right, from, billionaires and centimillionaires is that any way you can take $1 and have it do multiple things for you, that's how you can exponentially scale, right? So if we can take that capital and then have it growing tax-free for us, we can have it avoid estate taxes and probate taxes. So now we have some estate planning to it. Obviously, we have a death benefit to it, but we've also created infrastructure, which is control around that capital, right? So now we have control on that capital and we can borrow against it. So if we need liquidity, I have a liquidity, warehouse, being able to access capital, have dry powder for that next great deal that comes along. Or, let's say you've got a medical emergency, right? And someone can't work in the family for a year. Well, I've got enough, runway to be able to operate my family, right? And it's in a super efficient way. Now, on top of that, then we look at these other asset classes, again, of real estate, energy, and private credit to fill those spaces of looking at growth capital, looking at cash flow, and looking at tax efficiency. And obviously, there's some, real customization on there depending on, maybe you're an entrepreneur, you just exited a business, we've got this liquidity event. So, tax efficiency is huge. Right. That's what we're really looking for. Other people are looking to build up that passive income, right? So we can escape the rat race and just, we want to get to our freedom number as fast as possible. So, right, what's the best way to do that? And then we also love to look at things like, we call it really, strategy stacking, where we could, let's say, use the infinite banking. Maybe we borrow from that policy, then invest in something like, that real estate deal, right? Or the energy deal to kind of lower our taxes, right? Still create cash flow, still create upside. And now you're using the same capital twice, right? There's a lot of really cool things. Or for instance, most Americans really have capital tied up in two places. It's in trapped equity in their primary residence, or it's in government-sponsored qualified plans. So if you've got something in a 401k, number one, you can't access it, but likely it's doing about a 7% return. And that's before taxes, fees, and inflation, right? So you could actually put that into a self-directed IRA, put it into our credit fund, and 3x your return, right, on what you're getting there. Right. So that's like a really cool way to actually optimize. In my book, that's phase 4 of the holistic wealth strategy, where we talk about repositioning capital. Right. So how can we look at your existing portfolio stack and say, okay, how can we optimize the assets that you have for, less risk and also higher upside?
No, that's terrific, and all great points. And going back kind of to the infinite banking, we've had several different folks on this show, but for somebody that's listening to this particular episode, when a lot of times when folks think of life insurance, for instance, they are thinking of it as what they're doing to kind of offset if they were to pass, and kind of being able to pull money out of it is sort of a foreign deal for a lot of folks. I mean, on whole life policies, eventually, if they're set up just as a traditional, you're going to have a cash value at some point that you can start to utilize. But can you maybe just for the audience talk a little bit about how these are structured differently from the get-go, and that, there is a cash value right away. So you're deploying money into these things, but you're able to get, a big piece of it out right away, and be able to use it for investments and some of the benefits of being able to do that as well. So.
Yeah, you bet, Keith. Look, there's a lot of confusion in the marketplace, right? People call it different things. You could call an insurance company, they won't even know what you're talking about. So the key is to work with someone who completely understands how this works, and to be structuring it in a way that will work with which we're talking about, right? And Nelson Nash was the individual who really kind of started this framework around how to, create this infinite banking. And ultimately what you're doing is you're kind of taking over that function of the bank, internally. So now you have sovereignty with your capital to be able to use it as you want. Now, simply put, it's a cash value whole life policy that's structured in a certain way to be able to do that. So you could start that policy by, let's say, putting in $100K for the next 5 years. Within 30 days, with something called paid up additions, you can actually have access to a good portion of that capital. So you have cash value in it right away. Some people will have a liquidity event, or maybe they're going to sell a position in the stock market because they don't like the volatility of the stock market. So you could actually take that capital to pre-fund this thing up front and then actually get it going, or you could take, like we've set this up for our kids, right? I mean, my daughter is in her 20s. If she does nothing but put 10,000 into this thing till she's 65, will literally have tax-free income of 6 figures by the time, she's 65, right? And also have access to this capital, to go buy a house when she wants, or do, different things, or invest in things like that. So you fill up this bucket, think of it as like a bucket, right? Where you're filling up this bucket of cash, and at the same time, the capital is growing tax-free, and you can then obviously you have a death benefit that's correlated to it. That's how it's set up and structured. If you have a family, right, you can give this to the cash value to your heirs tax-free and avoid probate, right, which is a great form of estate planning. It's also a form of asset protection, by the way, because if you have capital in your house or in stocks, bonds, mutual funds, anywhere, a creditor, that's the first place they're going to look, right? To access your capital. But if you have it in life insurance protected, your family is protected there. But this coolest part of it, right, as investors, having the ability to borrow against the policy and then use that for again, like I kind of see it at like two levels, Keith, how I manage mine. It's like, okay, let's say I've got 12 months of emergency capital. Where do you keep that? Not in a CD, not in a money market. You want it safe and compounding tax-free. Well, that's where I keep it in my policy. And then the second layer is more my dry powder. So as I get cash flow that comes in from all my different deals that I don't need, it goes right back into the policy.
Yeah.
Right? Until I fill up that next, tranche of 50, 100K, whatever it is. And then I have dry powder to go invest in the next deal. And that way, like, again, you're creating so much velocity on your capital. And there's even a little bit of an arbitrage, because you usually might have like maybe a half point, maybe in some cases even up to a point on when you borrow versus putting that capital into another investment. And you're also, this takes a little bit to get your head around, but when we say we're using the same dollar twice, let's say you had, 100,000 cash value in the policy, and then you borrow against that, and now you're putting that into another asset. The compounding value of the cash value policy is continuing to compound over time.
Yeah.
And so is the investment that you're doing. Right. So that's what's really slick. And a lot of people, the biggest things people come back is say like, well, it's making like a 6% return. I can do better than that than something else. It's not the way to evaluate this. This is a long-term strategy, and you have to look at all the different things that it's doing and placing a value on that. If you have access to capital at any given point in time, you don't need to put stuff on credit cards or go to a bank when you need capital. Like, what's that worth to you?
Yeah. Or
what's it worth to know that you've got extra protection in case something happens to you, to your family? What's that worth to you? What's it worth to avoid, 6 figures, 7 figures in, taxes and probate when you die? Right. There's things like that. And then the other objection people always talk about is like, oh, well, I've heard that's a scam, or people are trying to make money. There's fees, 100%. There's fees to it, and the way though that it's structured, if it's done right, the fees are actually minimal as you do it. And then you have to look at this over 10, 20, 30 years, and you see the accumulated value, which is massive, right? And once you start investing in this over the long term, right, it's a really safe plan B, because you're completely non-correlated to the market, right? So, and insurance companies have been paying dividends since the Civil War. Right. So it's another great way to also be non-correlated to the market and have like a really good safe strategy in place, if, your real estate investment didn't pan out, right? Or these other things you were banking on.
No, for sure. No, I think it's an amazing tool for sure. And so thanks for that explanation. I think that it really helps. So you're using, I love it. You're layering in all those various things. What are some, maybe Dave, some other things within the book that if you want to just maybe highlight some of the other key points of the book, and then I want to definitely make sure people know where they can find out more about you.
Yeah, probably the biggest takeaway from the book, and it's basically a simple 5-phase framework, and it really provides context wherever you are in the journey to really, really, truly think about your wealth and dial in a way to truly 10x that and get to your potential. And phase 1 is actually all about you. Right? So it's not an investment. It's not a tactic. It's about investing in yourself and actually looking at yourself on the balance sheet as a number one asset. Anytime I spend money on myself through masterminds, through listening to great podcasts like this, through reading books, right? Or by hiring coaches, right? I get a 10x, 100x type of return, because let's face it, we're all in this knowledge-based economy now, and we're playing a game of 3-dimensional chess. So how are you showing up to play that, right? So the more I can invest in myself, I'm going to get the biggest level of return. I'm going to play the game at a higher level than other people are. So, as I do that, right, I'm creating goals, and I'm creating habits that support my vision and support where I'm trying to go.
Yeah, yeah, that's great. Very good. And how can people find out more about your like Pantheon investments, and how where can they go to see what you currently have available, what you're doing, and keep up with that and subscribe if they'd like.
Yeah, what I wanted to do for your audience, Keith, is actually just provide, if any of that resonated, just provide a free copy of the book.
Oh, that'd be
So you could
fantastic.
go to holisticwealthstrategy.com and connect with us through there.
No, that's fantastic. Okay. And we'll put that in the show notes for sure. And then as far as the Pantheon investments, what's the best place to go if that people want to invest?
Yeah, I mean that's pretty much the same channel. If
Same
you kind
channel.
of
Okay.
enter in that way, yeah, you'll find us in there for sure.
Okay, perfect. And I've got a couple other questions for you, Dave, that I ask every guest. One would just be, any advice you would give somebody who is maybe just starting out in their investment journey.
Well, okay, this is going to be a little biased, right? But I would say, definitely read my book. And um, I've actually got, so my triplets now,
Hmm.
um, they're actually all 25, and then my oldest is 27. So we actually started really early on, right? Talking about money, having masterminds in our family.
Hmm.
But now the kids are really, building up some capital, right? They actually have IBC policies set up. My oldest she's on to her third rental property right now,
That's
and
exciting.
really crushing it, playing the game, which is cool. And it shows that wherever you are, it's never too late, right? To start, you've got to get in the game. But we're having this question a lot, like, okay, if I got, 50K, do I do a short-term rental? What do I do? And the biggest recommendation I would say is that, like I said, really do some really deep work on yourself and really understand yourself in terms of, what are your true strengths, your unique ability, your superpower, your working genius, whatever you want to call it, to figure out how can I take those strengths then and then actually apply those to an asset class that I'm going to love.
Yeah.
Right? Like if you put me in front of like trying to trade cryptocurrencies or something, I
Hmm.
mean, I'd go out of my mind. That would be for me like reading legalese, right? And contracts.
Right. Right.
Because I've done so many different assessments and things like that. And I'm a people person. And that's what I love about real estate and private equity. This is a people-based business, right? So I'm following my natural tendencies. And I also have a really good handle on my risk tolerance, right? And what I'm willing to do. So I think for those people just starting their journey, really figure out your investor DNA. We kind of have some tools and things like that to think about. Colby is a really great one. If you go to KOLBE.com, that's more on your instinctual wiring, really enlightening in terms of that. So understanding yourself. And then if you think that, decide whatever asset class or asset type you're going into. So if you think, hey, you're non-accredited, maybe I want to do short-term rentals because I think that's a great idea. Well, literally, like hire a mentor, take some courses, spend 9 to 12 months, like getting 1,000 hours in
Yeah.
on this, right? Before you invest, and then take action.
Right.
Right? Don't get analysis paralysis, take action and see if that's right for you to kind of get in the game. You're going to lose money in this game. I'm certain of it. But I can tell you, if you're playing it right, you're taking action, you're increasing your financial IQ, you're increasing your emotional IQ, that, your gains are going to far exceed any losses you have.
No, for sure. That's great advice. I appreciate it, Dave. And then how about a book recommendation? It doesn't have to be real estate or even investment related, but it certainly can be. Just something you've read that's been impactful.
Yeah, sure. I'll tell you the one that's on my nightstand right now is The Art of Impossible by Stephen Kotler. And it's all about achieving that flow state, right? So, surfers call it like the flow state when you're on the wave and you're at this point in time, or just everything just stands still and you're so in the zone, right? And studying really peak performance and how can we really operate in the most optimal state of being, and it's completely effortless. Because to me, that's part of true fulfillment, right?
Yeah.
I want to actually get paid to exist and just do what's my unique ability and what actually energizes me, and not, have some job, right? I don't want to be working, right, going through the motions for something. I want to be in that flow state where I can actually take my strengths, my unique ability, and create the biggest impact as possible. And in my case, it's trying to help other people figure out this contrarian game to wealth, right? Because let's face it, 99% of the world is saying just put your stock market, you put all of your investments in the stock market,
Right.
trust your financial advisor, and that's investing, right? But that's a rigged game. If you're smart and you start asking questions, you're going to realize it's a rigged game, and it's not meant for you to succeed. Right? It's meant for Wall Street to succeed, the government plans to succeed. So you have to start asking questions, right, and figuring that out. But again, a great book. Think about how you can constantly invest in yourself, and try to achieve that, flow state. Figure out what your unique ability is and how you can apply that to your own business or, where you're headed in life.
Nah, it's great. I have not had that recommendation. I always ask for the audience, but I asked for myself as well. So I'm going to add that one to my list. Dave, this has been great. Really appreciate you being a guest on the Wealth Flow, and I think we'll call it a show. Thank you.
Awesome, Keith. Thank you so much.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.